It's said that management consulting is for everybody, and people with backgrounds outside of business can compete in case interviews just as well as anybody. And very little to no business background is needed for case interviews. No, it does not work like that. Hi, my name is Kim Tran, a former McKinsey consultant and the founder of the platform Management Consulting Prep. Even through all consulting firms' claims that the consulting career is for everybody of all education backgrounds, no matter what, case interviews always involve quite a few business concepts. For non-business students, this may bother you from the actual study of case interview skills. So I hope through this very compact video, I'll be able to provide you non-business people everything you need before starting to learn cases just like a business student. If you're already a business student, you may skip to the later part of the video through this. The later section may contain some contents that not all business students know. The video is presented using the 80-20 principle. 20% of business knowledge can get you 80% as equipped as normal business students. We will select most basic but high impact terms and concepts. We've divided this into 4 chapters. Number 1, accounting and financial terms. Number 2, how a company is typically organized. Number 3, business strategy concepts. And number 4, management consulting terms and concepts. Okay, chapter number 1, accounting and financials, the language of business. Well, it takes accounting students years to learn all these concepts, but I'll try to do my best to cover it in under 5 minutes. There are 3 legendary financial statements: balance sheets, income statements, and cash flow. Balance sheets are like a snapshot of the current stage of the company's property, debt, and ownership at one given point in time. Sure enough, the balance sheet shows 3 figures. Assets, what the company owns: buildings, equipment, cash, inventory, along with some other intangible items as well. Liabilities, what the company owes: loans, bills to be paid, etc. That is like negative assets. Take assets, subtract debt, we have the net worth or book value of the company. It's called equity. The neat thing about the balance sheet is that it's always balanced. Every action, every transaction changes the 3 components, but it's always in harmony. A few examples. Take cash to pay debt, both assets and liabilities are reduced. Owners invest more money into the company, assets and equity are both increased. Sold a service for some cash, assets increase, and so does the equity. We'll talk about the mechanic of how equity really changes in more advanced videos. Above, I showed you a few important components of the 3 big parts: assets, liabilities, and equity you may need to know. Sometimes they're categorized in one way or another, but most of the times you can easily grasp them. Next financial statement, the income statement, sometimes called the profit and loss or P&L. While the balance sheet is a snapshot at any given time, the income statement records the business performance through a period of time, say a quarter or a year. The income statement directly tells you how the company is doing in terms of making money, the heart of any business. From the top to bottom, the income statement shows the revenue, costs, and profit. That's why oftentimes profit is referred to as the bottom line. While revenue is straightforward, cost has a number of tricky components. Here are a few most frequently mentioned types of costs. The cost of goods sold refers to the direct cost of the product or service sold. For example, if I sold you a $5 t-shirt, which I bought at the price of $3 earlier from Walmart, then my revenue is $5. My cost of goods sold is $3. Marketing expenses, salaries, administration expenses, depreciation, and amortization. These are interesting types of costs because they are non-cash. It involves a big cost the company pays upfront for a big thing, but that big thing adds value over a long period of time and therefore being allocated throughout a longer period. An example of depreciation would be the cost of a building allocated throughout decades. Amortization is just the different version of depreciation used for intangible assets such as patents, licenses, etc. Interest expense. And lastly, tax. Depending on specific needs and conditions, companies break down the statement into various further steps downstream, along with a percentage of the total revenue called margin. For example, we have gross profit, which is just the revenue subtract cost of goods sold. Along with this, we have gross margin percentage. EBITDA, which stands for earnings before interest, tax, depreciation, and amortization. Along with this, we have EBITDA margin percentage. EBIT, which stands for earnings before interest and tax, along with which we have EBIT margin percentage. One important thing to notice is that even though it may seem like it does, the income statement does not necessarily relate to the cash or any money factor. Many of the times, especially for business-to-business transactions, the selling happens before the money flow. So we may have to record a revenue without having the cash yet. So how do we keep track of the cash? That leads to the third financial statement, the cash flow statement. There's a famous saying that income statement is an opinion, cash flow statement is the fact. Interesting, huh? The cash flow statement just strictly monitors the cash flow in or out, categorized in different sections. 3 of them are operations, financial, and investing. Okay, so that brief overview is all of what accounting students learned during their college years. These basic terms and concepts should help you have a head start in the realm of business. Chapter 2, how a company is typically organized. When it comes to that, it's important to notice the fine line between companies' ownership and management. Technically, at the highest level, there are shareholders. Each share or stock represents a part of the company's ownership. For private companies, the group of shareholders and their shares are not necessarily disclosed or publicly tradable. For public companies, on the other hand, shares are publicly traded on different stock exchanges. One of the most famous is the NYSE, which stands for New York Stock Exchange. Now, a company can have one, a few, or millions of individual owners. So having that many people directly involved in companies' decisions is not a good idea. That's why they do it indirectly through something called the board of directors, or sometimes the board. They're a group of people elected by owners to help govern the company. The head of the board is called the chairman or the president. Technically, this is the highest position for a single person in a company. Now, while the board does a lot of important work, they're not there to do the dirty day-to-day work. The board usually hires a management team to do that. The head of the management team is called the Chief Executive Officer, or the CEO. The CEO is the highest position on the management side, making every decision on the day-to-day work. Most of the time, the board of directors doesn't directly intervene in the CEO's work, but they reserve the right to fire CEOs. As I said before, the board is not really there to work, it's there to lead. So to further help them do that, there's a committee called supervisor. The supervisor's job is to independently monitor the CEO and the management team and report to the board. Now comes the interesting part. Below CEOs, there are generally 2 ways of structuring the company. One way is through business lines and the other is through functions. Think of business lines as a mini company in and of themselves inside the big company. Within functions, here are a few most of the typical divisions that companies will have. Accounting, in charge of keeping the record of all companies' transactions and making meaningful reports based on them. Finance, in charge of managing the money aspect. I often think of finance as how to not having too little cash and how to not have too much cash. Having that much cash sitting around and doing nothing is a waste of resources, and companies usually involve various investment activities to best utilize it. Marketing. Now, the definition of marketing can vary by a huge number of factors. To me, I often think of marketing as how to put the company in the position to sell as much as possible. This involves doing branding, communications, setting up pricing policies, developing distribution channels, and last but not least, to orient the products. Sales. In many companies, sales and marketing are put together, but there's a slight separating line. Marketing is about putting ourselves in the position so that people can find us, quite a passive way. Sales, on the other hand, is to actively go out and sell products. Operations is in charge of running the company, making it efficient. This is so big that sometimes we have the notion that COO, Chief Operations Officer, is in fact the Vice CEO. Product development and research is in charge of making the product, whether it's tangible or intangible. Strategy is in charge of planning and monitoring business performance to achieve goals and objectives. This is probably one of the most underrated divisions of all companies. Many companies don't even have a strategy department, making it by default the role of the board and the CEO. This is where companies like McKinsey, Bain, and BCG often come to help. Chapter 3, Business Strategy Concepts. Okay, here comes the part where even some business students may need to hear, especially if you're not a strategy major. I'm going to give you some of the most basic concepts about strategy, which you'll need to use a lot if you become a management consultant. Organization. In general, this refers to how a company is organized. What are the different components that make up a company? Organization is often presented through org charts. Here's an example of the org chart of my family. We have mommy as the big boss, daddy as the big boss's assistant, and various business lines represented by my brothers and sisters. Governance. This refers to how a company is managed and directed, how well the leader team runs. The leader team includes board of directors, BOD, and board of managers, BOM. A company with good governance has good leadership, tight control, and effective check and balances. My family has an amazing governance. Dad and mom's roles are very clear. They hold a brief meeting with us every day through our dinner. And once a week, we sat down together for a big meeting where big family issues are discussed and voted on if necessary. They even have all the children act as supervisors, monitoring the activities of each other and many, many more. Process. This is like rules and common practices, having a number of processes entailing every single activity. A process design should include 4 factors: who, what, when, and accompanied tools. For example, let's look at my family's excursion process. The who part is presented on the y-axis, left-hand side, labeling all departments, aka family members involved. The what part is presented through the big midsection with each box representing a single activity. The when and tools parts are presented at the bottom. B2B versus B2C stands for business to business and business to customers. These two terms refer to 2 types of transactions a company typically does: transactions with other companies and transactions with individual customers. Bottom up versus top down. This refers to 2 opposite schools of thought or action, each with its pros and cons. For example, if the problem is, where is my lost key? Then a top-down method would be to divide the search area into different regions, floor 1, floor 2, floor 3, then tackle each region one by one. For a bottom-up method, on the other hand, I would go right into the very specific spot I think I may have placed my key, say on top of a microwave, behind the TV, etc. Chapter 4, Consulting Business Terms. Okay, in previous chapters, I've introduced you to some of the most commonly used concepts in business strategy. Now we'll talk about those that are particularly popular in consulting. Lever. Think of this one as a group of initiatives or actions to perform to meet certain goals. Some levers to help increase customer experience in a hotel are free breakfast, free Wi-Fi, 24/7 support, etc. Best practice. This refers to how things should be done, especially if it has been successfully implemented elsewhere. Industry versus location versus function. Now, these are 3 parameters the consulting word uses in the categorization of businesses. Industry is used to group different companies, mostly based on their product. For example, a banking industry, construction industry, education industry, steel industry, etc. Function is the categorization mostly based on missions and types of roles of different parts of a company. For example, human resources takes care of people-related missions. Finance takes care of money-related missions. Some other important functions most companies have are strategy, operation, sales and marketing, product development, etc. Location is where things are geographically. So normally when 2 consultants ask each other on what do you work on, they need to give 3 pieces of information in all of those 3 parameters, such as So I worked on a cement project focusing on finance in Southeast Asia. In fact, all of the McKinsey support networks are organized in this way. During my projects, I would need to speak to some cement experts, some finance experts, and some local experts as well. Granular. This refers to how specific and detailed a breakdown or an issue goes. For example, a not so granular breakdown of the NBA is the West and the East conferences. A much more granular breakdown is something like this: leagues, conferences, divisions, and teams. MECE. MECE is so important we have a whole video on it. See it here. But in short, MECE is the standard way in which we can divide things in a systematic, comprehensive, and non-overlapping manner. Phew, this is a relatively long video, but it's still way shorter than 4 years of college business education. But I hope it acts as a great prerequisite to your case interview study. Feel free to go back and watch this video a few times if you need to. Once you've gotten all the content here, you know what? You are ready to tackle case interviews. Go right ahead to the Case Interview 101 video and you'll have a great time. Also, if you're interested in learning even more consulting terms and concepts, please get a hold of this detailed PDF, which you can download for free from our website. There you'll find way more terms and concepts with descriptions and examples. Please find the link on the video's description below. Now, the fact that you make it to the end of this video is proof of your commitment to learning case interviews, despite the non-business background. Keep up your spirit and soon you'll find yourselves coming toe-to-toe and possibly even performing better than business students. It's harder at first for you, but the more you study case interviews, the more you'll realize it's more about problem solving, and the business things are just the context. At Management Consulting Prep, we believe everybody can make it to consulting. You a believer?